Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Presidents Trump and Xi locked in a showdown, with both countries claiming the ball is now in the other's court as the clock ticks toward a further escalation in import tariffs. Risk sentiment in the markets improves, but raging beneath the surface of short-term fluctuations is the great debasement debate. Are investors really pulling away from sovereign debt and currencies in favor of precious metals and Bitcoin? We ask Adam Levinson, founder of global alternative asset manager Gamma. Also ahead, Asian rare earth stocks extend gains as escalating US-China tensions reignite investor interest in strategic minerals. Cory, head of critical mineral supply chain research at Trivium, China, will be joining us to discuss how a supply shortfall could affect the global economy. Well, let's get straight to our top story. Asian stocks are mostly higher amid easing trade tensions between the US and China. Treasury Secretary Scott Bessent says he's still expecting Presidents Trump and Xi to meet later this month at the APEC summit in Korea. But Bessent is warning that all options are on the table for retaliating against Beijing's move to tighten exports of rare earths. China, for its part, has defended its decision after holding working-level talks with U.S. officials on Monday. And while the latest tariff spat between the U.S. and China is still top of mind of investors, money managers have also been increasingly discussing a phenomenon known as the debasement trade. The strategy involves pulling away from sovereign debt and currencies as investors seek to protect themselves from threats posed by runaway budget deficits. For more on this, let's bring in our senior FX and rates reporter, Ruth Carson. And we know, Ruth, that this is really gaining momentum, rippling effects across markets, Singapore to New York, Japan to Paris. I'm just wondering, why is it happening now?
It's a great question, and it's certainly being debated everywhere as to what the answer actually is. Now, when we look at where markets are today, you've got governments that are spending heavily, deficits that are ballooning, yields have shot up as well. It's making investors everywhere really start to question, are we investing in the right assets? And we're seeing that. We're seeing that reflected in the prices of gold that are at records, silver that are at records, and Bitcoin, even with the pullback that we saw on the weekend, it's still at all-time highs after rising over 20% this year. It's that rush towards alternatives as people really grapple with the question of viability.
You talk about how we're seeing that massive run-up in gold and silver, in cryptocurrencies, Bitcoin in particular. The question is, how much more upside are we expecting? Is there more upside?
Isn't that $1 trillion question? And we'll all be billionaires if we got that correctly. At the moment, just talking to traders everywhere, which is part of my daytime job, we're finding that rush for gold hasn't abated. Yes, every other day we're seeing new records, and people are saying it still has further to go. Now, key to all of this, particularly when it comes to precious metals, is this. It's not just the punters that are doing it. You've got reserve managers, central banks, pension funds, life insurers. Take your sticky money pick. They're all doing it, aren't they? Plus, you've got the upside from day traders and money managers, the asset managers who act on behalf of these super large investors, all saying, you know what? Buy gold. It's a hedge to almost anything at the moment.
Surprising, right? I mean, just a year ago, you wouldn't think so. And we've been talking a lot about de-dollarization as well. To what extent is this a continuation of that? Or is that above and beyond? Is it something bigger?
It's a cocktail of both. So yes, de-dollarization has been something that has been debated about for years, actually. And that definitely gained traction this year, considering the dollar has dropped quite a bit, more than 7% this year alone. Now, is the debasement trade reflective of the de-dollarization trend? Yes, people can argue that, but it's also arguably a shift away from fiat currencies. Think about it. You've got the dollar under a lot of stress, as we know, from attacks on central bank independence to Trump's trade war. But you've also got problems with the yen, right? The haven that we once knew it is arguably no longer the haven that it was. And if last Friday's, implosion of politics shows, there's plenty of uncertainty there as well. Euro has its own problems too. So in a way, it's almost as if people are, the trust towards fiat is chipping away a little bit. And as a result, it's bonds as well.
Bit by bit. Ruth, thank you so much for that. Our senior FX and rate reporter, Ruth Carson there. Let's bring in Adam Levinson, founder and CIO at Graticule, a global alternative asset manager. Adam, good to have you with us. What's your take on this debasement debate? It is gaining momentum. It is the hottest investment trend in town. Are you buying into that?
First, thanks, Haslinda. Thanks for having me. I'm buying into it because it's been the most persistent, robust trend, and it's very hard to ignore. As you were just talking about moments ago, it's really primarily an anti-fiat currency movement. That's a function of a lack of trust in a lot of governments around the world that show no ability to curtail spending. They want to run out of control deficits. And so citizens, investors, professional or otherwise, are turning to non-fiat instruments. And then additionally, the backdrop is also occurring around a massive wealth redistribution among age cohorts. Two younger generations, pools of very large savings in developed markets. And those younger generations have a very different preference profile, primarily toward crypto and Bitcoin in particular. But gold's a part of that mix, as is silver. And you're seeing that routinely each and every day in flows.
The thing is, it's still being debated, right? I mean, not everybody's buying into it. You are. But when you take a look at yields, for example, Ruth talked about how yields are trending higher. But if you take a look at the past 3 years, yields have pretty much been range bound. And that does not suggest debasement.
Well, yields have been range bound. Real yields have been quite low. And as a function of that, there has not been a major impediment to shift away from paper or fiat related assets. And so, you may suggest that people aren't buying it as much of a debate, but you can't find a more persistent trend in markets that is away from fiat generally over the last 2 years. And so remember, what you're also dealing with is the savings pool is enormous, absolutely enormous. Just small adjustments or movements in that direction, are very large sums and have a displacement effect on these other assets, which are not particularly deep markets historically.
So just to be sure, the debasement trade does not require higher yields.
No, debasement trade doesn't require higher yields at all. The debasement trade is facilitated by low real yields, but you're seeing the back end of yield curves, particularly in places like the UK and France, which are arguably more problematic than the United States in this regard. But there you're seeing a revolt of investors, by investors, unwilling to hold the long end, despite yields rising. That's not attracting new flows in. It's more of a warning that the back end can become discontinuous or unruly at minimum.
Those who do not believe in the debasement trade also point to the dollar. Yes, we saw, how the dollar dropped in the first half of 2025, but they say it is just the unwinding of the rally that we saw in 2024. What do you say to that?
I think that's largely true. Look, the dollar, if you look back over the last decade, the decade of so-called U.S. exceptionalism, the dollar just received an overwhelming amount of flows. And so just a natural unwinding of that to a degree has been an adjustment downward in the dollar. And while that too may continue, that's been contained around, what you might say is just sort of reasonable volatility of that asset class. The bigger trend has been the debasement more broadly, which is out of fiat altogether. The other part of the dollar trade, and this runs counter to the de-dollarization idea, and is the notion of the growth in stable coins, which is effectively dollarizing, much of crypto that isn't in Bitcoin.
So, Adam, when it comes to the dollar, has it turned? Is this a pivotal moment for the currency? Where do you see it go from here?
I don't think it's particularly pivotal. I think it's simply just a pause in a trade that is somewhat advanced over the course of this year. And you can have slight unwind, small waves of adjustment higher in the dollar, but nothing's changing against the backdrop that we just described. And so, other than marginal position adjustment, the underlying forces that are pushing this trade, pushing the reallocation, are in place. And so you will see somewhat further de-dollarization, but I suspect the most persistent trend remains debasement and out of fiat currencies looking for alternatives.
And of course, this has played out in the crypto space. Some say perhaps Bitcoin is getting to 120. What's your take, and what have you been doing with cryptos?
Crypto. Let's separate two things. First of all, and that is Bitcoin itself, which really is this generation's digital gold, and the proxy, if you will, for debasement. And what I would suggest is everything else going on in crypto. And that to me is probably less well understood broadly. The real trade this year has been the start of something incredibly significant, and that is what we describe as the convergence between traditional finance markets and digital finance markets. So TradFi and DeFi convergence, which we think becomes very pronounced over the next 3 to 5 years. That was facilitated by the shift in regulation in the United States, effectively, welcoming the development of crypto markets, and the recognition, or what should have been the recognition, that stable coins really are the killer app, mostly built on Ethereum, some on Solana, but stable coins being the point of porosity now between these two markets. So whereas over the last several years, you could argue 7 or 8 years really, crypto was often thought to be great infrastructure with no real product. With stable coins, you have a genuine killer application that now allows for an entire new financial architecture to be built on top. And so you've seen the start of this in a number of different elements in crypto. The most significant this year being the expansion of DATs, or digital asset treasury companies, outside of just MicroStrategy, what Michael Saylor had done in Bitcoin space. But in some ways, it has allowed you to invest in almost venture with liquidity, which has been somewhat extraordinary. If you've chosen wisely, you've seen absolutely extraordinary growth in these companies, and that's consistent, frankly, around what you see in financial companies built on these new rails, right? The most glaring example,
right,
is Tether, and that's raising money at a valuation of $500 billion. That makes Tether the second most valued financial institution in the world. People don't necessarily think of that immediately. Second only to JP Morgan. And it's a company that has 150 employees. The profit, if you will, or revenue per employee is just unlike anything we've ever seen before, versus JP Morgan's 330,000 people and still unable to deliver, much of a customer service experience. It's not a surprise that these same younger age cohorts that are inheriting a tremendous amount of savings in this.
Adam?
Yes.
We'll delve deeper into digital assets just slightly later after this short break. Adam Levinson from Graticule Asset Management Asia will be staying with us. Now, still to come, LG Electronics India looks set for a strong trading debut after its $1.3 billion IPO drew heavy investor demand. We'll be live in Mumbai later this hour. Much more ahead. Keep it here with us. This is Bloomberg. Welcome back. Big swings in Samsung Electronics today, with the tech giant erasing an initial gain after reporting its biggest quarterly profit in 3 years on surging demand for AI-linked chips. Samsung has been playing catch-up to smaller rival SK Hynix on the AI front after a series of development missteps. Now, amid the debate over the strength of the AI rally, let's discuss what the next big opportunities may be in the technology. Still with us, Adam Levinson, founder and CIO at Graticule Asset Management Asia. Adam, we know we've been talking about this AI bubble angst, but there's still huge, big trades out there, right? I mean, you say you're pretty excited when it comes to powering the AI infrastructure. Not that sexy, but you can expect big returns. Talk to us about that.
We think it's dramatic, Haslinda. Actually, sentiment in markets today centers around just a few big concepts. One obviously is the U.S.-China relations and tariffs. The other, and the one that primarily everybody spends an enormous amount of time on, is where are we, so to speak, in the AI bubble, if it's that. And our contention is we've got still a very long way to go. Even if you accept that we should use the internet sort of 97 to 2000 analog, we're perhaps running ahead of it in terms of relative investment, per unit of GDP at this point in the cycle. But overall, the internet investment as a percentage of GDP peaked in the U.S. in that cycle at 1.3%, or somewhere around 85 basis points of GDP currently. Now, what makes it scary is GDP has grown a lot in the last 25 years. And so the numbers are very large, but we're nowhere close to even where we were then. And this is the most significant technology of our lives by far. And so it's going to exceed that in our view. The part that's abundantly clear and actually subject to very little debate at this point is you're going to need a tremendous amount of power to drive all the investment in the space. And it's only going to be generated a handful of ways. And you've seen, the market actually be somewhat agnostic, just now starting to recognize that you have to own power, a number of different ways. But our view is the most unique instrument in this cycle tends to be, in the short term, Bitcoin miners that are effectively converting themselves to high-performance compute. And you're seeing now deals that people thought about a year ago now coming to fruition all in the last several months. And then a company like Bloom Energy that had a very big day today on the announcement of yet another deal of integration into a new set of data centers, that being by Brookfield. But that's a company, it's not, this is funny. I made the comment previously about, with respect to crypto, where it was thought to have great infrastructure, no product. The opposite was true of a company like Bloom, which had a great product but no market. And what's happened is the market has now become ubiquitous. The need for power, the need to create what is essentially 100 gigawatts over the next 5 years of power generating capacity means that you have extremely asymmetric returns in this space, and we're not even close to being done.
And to your point, Adam, we have Bloom Energy, reaching a record overnight, and we had Bitcoin miners leading that crypto rally overnight as well. You talk about the energy footprint for the AI space. I'm just wondering as well, nuclear comes into play as well, doesn't it?
And nuclear definitely comes into play. And in fact, we made this argument in nuclear and started investing in nuclear and have had, many fits and starts since 2018. And I think that's part of the ultimate state of what gets built. The difference in nuclear is, in reality, over the next 5 years, in this sort of 100 gigawatt requirement, if you will, new nuclear probably delivers virtually none of that. The extension or lack of retirement of or previously anticipated retirement of nuclear is probably worth just over 10 gigawatts in aggregate. Whereas for us, we think Bloom alone will likely deliver 10 gigawatts of via solid oxide fuel cells with also no emissions. But the access to power, the time to power with Bloom is literally a quarter. And nuclear, any new nuclear, we're looking at 5 years plus.
Adam, when you take a look at the supply chain in Asia, where are the winners? What would you be betting on?
We've been deeply involved in Taiwan, almost across the board. The one thing that is, the other thing that I think is really not of any debate is whether it's GPUs or ASICs development, and clearly there's been a move recently, toward ASICs. In fact, ironically, the deal announced overnight between Broadcom and OpenAI is referenced as a power deal. The amount of XPUs in the form of 10 gigawatts. That tells you an awful lot. But all of that goes through Taiwan still. And so, it's somewhat remarkable. We know if you go back sort of 15 years, and the thesis was software eats the world, a number of investment professionals basically eliminated their focus on hardware. It was considered not sexy. We always stayed involved in it, one, because it was always relevant for a lot of markets in Asia, primarily Taiwan, Korea, and Japan. And second, even if you couldn't find opportunities in the supply chain itself, it always gave you insight into U.S. tech orders and early warning around macro.
We have to leave it there, Adam. Adam Levinson, founder and CIO at Graticule Asset Management Asia. Thank you so much for joining us. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're tracking big gains in Australian rare earth stocks with the strategic materials back in the spotlight on fresh US-China trade tensions. Beijing's expanded export restrictions on some rare earths are boosting bets on alternative suppliers outside China. Investors are grappling with the possible implications for global supply chains and the production of key technologies. Chinese trade expert Mi Zhu, speaking earlier on the China Show, defended Beijing's export controls on rare earths, saying they can strengthen global supply chains.
Some people think that China do not want to export our rare earth products, and I don't think that is the truth, because we still are, encouraging the companies to follow the market rules and trying to do the businesses with other trading partners. I know that China's rare earth industry is very strong, but it's not only because of our domestic market. We depend a lot on the global market, but the global market is based on some rules and certainty. So if we are continue to support the government, the government to support the enterprises in different ways to trying to give them more confidence, I think that the supply chains can be strengthened.
Let's bring in Cory, head of critical mineral and supply chain research at Trivium, China. Cory, good to have you with us. It does seem like China's weaponizing the rare earth supply chain. What do you make of the move? It does seem pretty confident.
Absolutely. There's a lot going on with these and a lot to speculate on, but I'd say two things are quite clear. First, it seems to me there is a retaliatory component, right? The expansion of the controls from 7 mostly heavy rare earths to 12. But there's also a separate and completely distinct part of these controls, which is the expansion into a more significant version of extraterritorial jurisdiction, basically saying and laying claim to China's control over very critical production chains, including for semiconductors. This is a significant expansion. I think it reflects the tensions between the US and China. This isn't just about leverage. This is a much longer term issue of how does China protect its interests? It seems to view this as one of the ways to protect its interests.
And of course, timing is crucial. It comes just before the intended meeting between Xi Jinping and President Trump on the sidelines of the APEC meeting. How effective do you think the move will be?
Absolutely. I mean, this is the first, from the moment these hit, all the speculation was, is this just leverage ahead of the negotiations? I don't believe that. Certainly it will be a point of leverage, but I think it was driven by longer, more structural issues and as a retaliatory measure to recent U.S. actions, including September 29th BIS rules, the expanded entity list. So there's all that to unpack. How does it affect the talks? Well, honestly, it would be hard to imagine that Beijing anticipated the ferocity of the U.S. response. And certainly, I personally think the U.S. Reacted somewhat emotionally to the news. And I think that's reflected in the fact that the U.S. kind of toned things down. Perhaps there's some back channeling. But we saw, U.S. President Trump's remarks that I believe it was, don't worry about China, it'll all be okay, kind of that messaging. I think it was a clear attempt to kind of dial things back because ultimately both sides are interested in these talks. It's not necessarily about getting a grand bargain, next month, this month, but it is about continuing to make incremental progress. I think both sides are interested in the talks still need to happen. That's the good news.
Yeah, but the thing is, these rare earths are critical to the U.S. Talk to us about the economic and security risks should China go ahead with the new restrictions.
Absolutely. So two pieces here. One is we've been facing the restrictions on most of the core heavy rare earths for quite a while now. The market's been volatile. They've been, producers have been hit very hard, but they've adapted. And so in some sense, this partial degree of decoupling in the upstream parts of the sector have already kind of played out. So I think there is at least, if there's a silver lining to this, it's that it's not a sudden new shock. It's an intensification, certainly, and it is very material. But in some ways, we've been figuring out how to deal with this for several months. And this is, we're going to continue the same process of trying to diversify. Now, that said, the real impacts here will depend entirely on China's degree of actually restricting licenses. Because again, this is not a ban. This is not saying that the US or any other country won't get them. It's saying that China has the ability to decide whether you get them. If things go well, presumably exports will flow. If things go badly, presumably they will not. Certainly there'll be some friction around, just like every other export control we've seen, there's always some bureaucratic delays and certainly a lot of uncertainty, even in the best of times. But right now, we could expect materials to continue to flow. But if relations deteriorate, certainly they have the power to cut the U.S. off.
So fair to say, even though we talk about China's dominance in rare earths, it doesn't mean that China can use it as a trump card. It's not going to checkmate the U.S. with it. Is that a fair way of looking at it?
I think, black and whites are very hard with this stuff. They can make life very difficult. Absolutely. And especially anything defense, aerospace, all that stuff. that can be hit very hard, very quickly. It was the first time around, it will be this time if China chooses. There are other areas, light rare earths, just to make a brief distinction, light rare earths versus heavies. Light is something that Mgmt materials and others are able to produce, increasingly able to process, so there is some more diversification potential. But heavy rare earths, it's very difficult to process, very time-consuming to develop the capacity to diversify that. Really, the champion here has been Linus out of Australia, working in Malaysia, and there's other efforts globally. There's certainly magnet production opened up in Europe and other places. It's still relatively small scale. It's going to be a while before we have material substitution of supply at the scale to supply the whole US, much less the rest of the world. And so I would say it's not the end of the world, but these risks are very real.
If you take a look at the curbs imposed by the U.S. on critical semiconductors on China, China has managed to navigate that and look for loopholes. Can the same thing hold true with the U.S. and critical minerals?
Yeah, absolutely. There's some distinction on the product versus the technology. Some things are easier to track than others. Some things have brand names. Most of these minerals do not. So the traceability is a little bit more complex. But to an extent, yes. And honestly, this is a sensitive issue, but the grey market is very real, and I think is probably has a bigger role in global market stability than anyone would like to recognize, if I'm candid. But that said, it's not something to rely on. We need diversification for global market stability. That's in the process. Certainly, the U.S. takes that very seriously with the DoD deal, the Pentagon investing in Mgmt materials, considering other deals. That's a reflection of the fact that at the end of the day, these are real choke points, real bottlenecks that have to be diversified.
So I guess the question really is, where are we with access? Where are we with supply? Because it's not just about the U.S. We know that European, nations and companies are also having issues with access. They've asked for China to, relax the exports of rare earths. So where are we in terms of access and supply?
A month ago, I would have had a very different answer. We were seeing some progress towards stream. And in September, rare earth exports plummeted. We don't know how much of that was a demand side, phenomenon, how much of that was restrictions on the supply side in terms of exports. I will say that, among the folks I know, there have been continued frustrations that even when they can get the exports they applied for, it takes time. MOFCOM still does not have enough people, in my opinion, kind of processing. And so there's certainly bureaucratic delays and frictions. Even when things are approved, it takes time to go through customs, because one of the big challenges implementing China's export controls is, of course, smuggling. Companies have a very strong financial incentive to try to move things out of the country that aren't approved. So what do? You do port inspections. You do chemical analysis of the material to make sure it is not mislabeled. That takes time and adds delays and creates uncertainty for companies. So we're in a very uncomfortable status quo, where we're not seeing widespread global shortages in the downstream things that we're producing. But at the same time, I don't think there's any producer who's comfortable with the situation. Everyone's under pressure.
Where are the most viable alternatives? Everybody wants in on it, right? We even have Malaysia wanting to get into deals with international partners to go into rare earths. So where are the potential reliable sources?
Absolutely. It's the billion-dollar question with no exaggeration. A few ways to look at it. Some people are looking at the deposits. I don't think that's the right way to look at it. There's this common refrain, rare earths are not rare. That's true. What's rare is an economically viable concentration of ores with sufficient grade to make it worth the investment cost. That is relatively rare. Malaysia has it. Myanmar has it in heavy rare earths. We're trying to get some of its heavy rare earth ores. That's really an unstable situation, so not the ideal place for most countries to be operating. Vietnam has some. There are light rare earths in the US that are being mined out of Mountain Pass, but not really heavy rare earths, right? So we have all these different things. But the real choke point, I think, is having the processing capacity, having the company that has the technology to whatever ore grade they have a hold of, to extract that efficiently enough to make it worth the cost. That is what is so difficult. And part of that is not just a physics question or a geology question. A lot of that has to do with the design of the business and the design of the investment and the quality of the technology. That's what we're seeing emerge as this competition Linus and NP are the leaders, I think, in terms of processing abilities coming up, heavy rare earths included for Linus. And we're going to see there's a lot of companies making a lot of promises that they're able to do the processing and make these investments viable. A lot of those have yet to be borne out. And so we're going to see a lot of companies tested by fire very soon.
And when it comes to the U.S., when do you see the U.S. potentially being comfortable with its access to rare earths?
Comfortable? Possibly never, in terms of the degree of uncertainty and just how important a lot of these minerals are, especially heavy rare earths, for defense applications. I mean, at some point, there's the market side, but these really are critical to national security, and that changes the nature of the conversation, truly. I don't think the Pentagon would have interfered in the market if it were not so critical for defense applications particularly, even though commercial applications are 95, 97% of that market. So first of all, that complicates things. But in terms of, kind of general market supply, I think it'll probably be, a matter of a couple, so if I had to guess. And don't make a bet on this, but if we're making a wild guess, I think light rare earths can come online much more quickly. When it comes to heavy rare earths, that is so much more difficult and so much more chemically complex to process and reach a stable state in your processing chain. That's going to be many years before we're very good at that at a large scale, in my view.
And if you take a look at the next 12, 24, 36 months, what do you expect to see in terms of the rare earth supply chain?
We're going to see a lot of investment. That much is very clear. What I expect to see is a bifurcation between the companies that say they have the ability to scale up processing very quickly and those that actually manage to. I imagine there will be a certain amount of speculative investment. There's probably, frankly, going to be what would normally be considered overinvestment, right? This is a sudden, dramatic need and a lot of unproven companies. Can they actually scale? It's a big question mark. I know folks in government or many, many different governments who are looking at potential projects. Their big question is, okay, company, you can promise this, but can you pull it off? A lot of times you won't know until they try. And so there's going to have to kind of be almost like a venture capital kind of mindset around this, except it's a totally different operating ecosystem. These are very large fixed asset investments. So I expect there will be a lot of money that, from one perspective, might sound like it's wasted and projects that won't work out. On the other hand, very necessary to try things out until we find the companies that are able to provide. And we'll see that settle out in the next few years. I don't think it'll take more than a few years to figure that out.
Great perspective there, Cory. Thank you so much. Cory Combs, Head of Critical Mineral and Supply Chain Research at Trivium, China. Now, the U.S.-China trade tensions are also pushing traders into precious metals as part of the haven trade. Silver surging into a record earlier today, topping the previous peak of 45 years ago, as a historic squeeze in London sparks a worldwide hunt for the metal. Gold also hitting a fresh record as well, past the $4,000 level, building on 8 straight weeks of gain. Silver currently 53.18, gold at 41.61. And here are some more stories we are following on trade tensions. An Indian trade delegation is set to visit the U.S. this week as the two nations work toward finalizing a deal. An official told reporters that New Delhi is also seeking to purchase more natural gas from the U.S. as part of the trade talks. Negotiations resumed last month after President Trump imposed 50% tariffs on Indian imports, the highest rate in Asia. And South Korea is reviewing a new proposal from Washington linked to its $350 billion investment pledge in the U.S. Delivering the investment has become a key obstacle to finalizing a trade deal reached in July. Foreign Minister Cho Hyun says Seoul aims to make progress by the APEC summit at the end of this month, where President Lee Myung-jung is expected to meet with Donald Trump. The Dutch government has seized control of Chinese-owned chipmaker Nexperia, invoking a Cold War-era law for the first time. Officials cited serious governance shortcomings at the firm that they say threaten key technological know-how. The move, targeting a unit of China's Wingtech technology, is expected to escalate trade tensions with Beijing. And China's Ministry of Transport says is exempting Chinese-made vessels from new port fees on U.S. ships. The fees are due to take effect on Tuesday. Jeffrey says oil tankers and container ships will be among the hardest hit. Beijing announced the levies last Friday as retaliation for a U.S. plan for similar charges on Chinese vessels. We're also watching Japanese markets now back from lunch break. Equity markets down as Japan's main opposition parties are likely to meet today to discuss rallying behind Yuichiro Tamaki as a unified candidate to take on Sanae Takaichi in a parliamentary vote to decide the next prime minister. Now, here's how it's looking for the Nikkei 225, currently down by 1.6%, losses for the topics. And taking a look at the Indian market, just kicking off the trading day, pretty much bucking the trend. The Sensex in positive territory, up 0.2%. The Indian rupee 88.75 versus the USD down about 0.1%. Still to come, LG Electronics India looks set to pop when trading begins shortly after a reported 30% surge in grey market trading. We're live to Mumbai next. Keep it here with us. This is Bloomberg. All right, 3 minutes into the Indian trading day, and the market's in positive territory. Barely. Sensex, though, still in the green, currently up 0.2%. The other benchmarks also in the positive. We have the Nifty 100 currently up by 0.2%. We're doing a check on Tata Capital, which is the biggest IPO in India this year after it raised $1.75 billion. It is extending its gain to 1.5%, though some say that its debut was a little muted, a little disappointing. Still in positive today, up by about 1.5%. Now, after that muted debut for Tata Capital, companies planning to go public are pinning their hopes on the debut today of LG Electronics India to rekindle excitement in the IPO market. And with shares of the home appliance maker reportedly surging in the grey market ahead of its listing, expectations are for a strong first day of trading. Let's get to Mumbai and Chiranjeevi Chakraborty, who leads Asia equities coverage. So it's going to be, I guess, a great performance today.
Yeah, I mean, it looks like we are going to have one of, a listing pop today, especially, which is quite rare for a $1 billion IPO in India, as you could, ascertain from Tata Capital's muted debut yesterday. But if you look at the grey market premiums, they are indicating at this point of time a more than 30% jump, which could potentially be the second biggest, first day pop for a $1 billion plus IPO in India, in India's IPO market history. So looks like a very good day as far as LG India is concerned.
Interesting to see when it comes to valuation, right? CJ, they say that this unit could be valued as much as a parent company. I mean, how is that even possible?
Yeah, that is the quirky bit about India's market, right? There is so much liquidity in the domestic market from retail investors, local mutual funds, and insurance companies chasing so few options, especially good quality companies and of good pedigree like LG, that these sort of instances do happen quite often in India, where the subsidiary or the unit could end up being valued at a much better valuation than the parent itself. And if the listing gains do extend after the trading debut, we could have ourselves a situation where LG Electronics India could be valued more than LG Electronics, its South Korean parent.
A lot has also to do with the potential of the, appliances market in India that is set to surge, and therefore a lot of, a lot is being priced into its stock performance.
Yeah, absolutely. I think one of the factors that really benefited this IPO was the fact that the company did price itself to a discount to some of the listed peers currently. And that has sort of attracted a lot of wealthy Indians, retail investors, as well as marquee, foreign investors, including a lot of sovereign wealth funds. And one of the reasons that people are excited about this IPO is the fact that it relates to the white goods sector, which is still quite underpenetrated in India. Remember, India is adding millions of people to its middle class every day. Urbanization is accelerating, and therefore it just makes a lot of fundamental sense to bet on a company that could see its sales and growth momentum continue going forward. And that is, I think, one of the reasons why investors are quite excited about this IPO.
CJ, it is raising a lot of money. How will it use the proceeds?
Well, at this point of time, I think one of the things that really stood out for me is that they plan to utilize the proceeds also to set up a new plant, which could be related to its export business. LG does manufacture a lot of its products in India for exports in other countries and other EMs, and I think that is quite interesting, given Prime Minister Narendra Modi's own focus on improving India's export economy at a time when India is facing tariffs from the US, which are among the highest in the region. So it is quite an interesting play, and I think LG India at this point of time is indicating that there is a lot of confidence in India's export potential, as well as the home market, which is quite a captive market for a company like LG Electronics.
CJ, great stuff. CJ Chakraborty, who leads our Asia equities coverage in Mumbai. Now, here are some more top corporate stories we are following. Airbus is opening new assembly lines in Alabama and China to boost output of its best-selling A320 Neo jets. Engine issues have forced the company to build gliders or planes completed without engines. Airbus aims to build 75 aircraft a month by 2027 as it works through a backlog of more than 7,000 orders. JP Morgan plans to funnel $1.5 trillion over the next decade into industries that strengthen U.S. economic security, from defense and energy tech to rare earth minerals. CEO JP Diamond says the move is 100% commercial and not philanthropy. The initiative will involve JP Morgan's asset and wealth management arm, which oversees client investments. Broadcom shares jumped 10% as it became the latest chipmaker to forge a blockbuster data center deal with OpenAI. The partnership aims to add 10 gigawatts of capacity by 2029 and allows OpenAI to tailor the chips to meet specific needs. No details were given on how OpenAI will pay for the custom chips and networking equipment. Let's take a look at Asian markets and how they're faring this Tuesday morning. They are retreating somewhat. As the U.S. equity index futures pair gains as well, a revival in risk appetite losing momentum there. Take a look at where we are in terms of the MSCI Asia Pac index, currently down about 0.5%. The Hang Seng also in negative territory. The Kospi bucking the trend up 0.4%. Meantime, though, if you take a look at cryptocurrencies, they're extending the losses. Bitcoin slumping more than 2%. Now, before we go, here's a look at our guests for tomorrow. JP Morgan's Raisa Rasid and Goldman Sachs' James Ashley will be joining us to discuss the latest investment insights. That's as straight as await inflation data out of China and trade numbers from India. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.